Frank Holmes, gold is up around 25% year to date, but your U.S. Global World Precious Minerals Fund is up over 150% year to date. So talk about why the miners are outstripping gold by so much.
Well, they went through a 4-year horrendous bear market, and to survive they had to make so many cuts, and finally they got a turn in the price of gold. But it's not just the price of gold that's gone up, because last year gold was down 10%, but we saw some other factors that made the Canadian gold stocks and the Australian gold stocks take off. That is, the price of oil fell. They need oil to process and build and run the mines. And two, their currencies got clobbered. So you had margin expansion even though the price of gold was down last year. Now this year, the price of oil is basically still lower, the currencies are still lower, and gold is rising. So you have this exponential increase in margins.
And you like the royalty stream plays like Silver Wheaton, Franco-Nevada. Why are these attractive to you?
Well, let's take a look at Franco-Nevada. They have $15 million of revenue per employee. They have royalties on Newmont, their revenue per employee is $380,000. Goldman Sachs is $1 million too. They have so much revenue, therefore they have such high gross margins per employee, and therefore they have the capacity to build their book value with cash and pay dividends.
All right, now what about supply? Are new mines opening up? Because we've seen the price of gold tick up, and this should mean that we're going to see some mines open up. Is supply being added to?
Well, you know, it's a great observation, but what's happened is that they've not found any big discoveries. There's been no technological breakthrough like there was for fracking in the oil industry. There's been nothing for gold. So you've seen for 10 years, billions of dollars spent on exploration and nothing to speak of. And then where they've had a few discoveries, only a few, and it's unprecedented how much money was spent on only a few discoveries, the governments of those countries turn around and move the goalposts, and they're not going to get developed. So in fact, there's peak supply theory that's taking place with gold.
All right, let's switch to demand. Where are we in terms of physical demand? We keep talking about buying gold because central banks are flooding the market with money, and you need to protect yourself from too much stimulus. That said, what about Indian wedding season and this type of thing?
Well, that's an important part, and I've always characterized there's two drivers for gold. There's the fear trade, which most of us focus on, and then there's the love trade. And the love trade is the rise in GDP per capita of China and India, affectionately known as Chindia. It's 40% of the world's population. And we've seen unprecedented gold consumption in China. And now last year, they surpassed America in the rise of their middle class. It gets lost in the sea of 1.4 billion. There's 109 million middle-class Chinese, and they're dominating tourism, and they're also buying gold.
And what do you say to people who say, I don't want to own gold, doesn't pay me a dividend? What's your response?
When we have negative real rates of interest, it's always proven that gold rises in that country's currency. So we've seen this around the world. Now we have $13 trillion of debt out there offering negative rates of return. After Brexit, Switzerland's 50-year government bond went minus. So I think the idea and the concept of gold is getting more and more traction as an important diversifier. And that's why I've always recommended 5% in bullion, 5% in gold stocks, and rebalance each year to be able to capture this volatility.
All right, gold's hot. Thanks for coming on, Frank.
Thank you.
Thank you for watching The Street.